Most people never realize how much their daily finances are shaped by unseen hands. Central banks quietly control interest rates, money supply, and credit, influencing the cost of borrowing, the value of savings, and the flow of investments. Their decisions ripple across the economy, affecting everything from mortgages to markets to global trade. In this video, you will understand how central banks shape money and why their influence is more powerful than most people imagine. Like and subscribe to learn how to see the invisible forces behind financial life. 1. The role of central banks in the economy. Central banks are not ordinary financial institutions. They act as the backbone of a nation's monetary system, creating stability and guiding economic growth. Their primary responsibilities include regulating the money supply, controlling interest rates, and ensuring that banks operate safely. By adjusting these levers, central banks influence spending, borrowing, lending, and investment decisions across the entire economy. 2. Controlling interest rates and the cost of money. Interest rates are one of the most powerful tools central banks have to influence money. By raising or lowering rates, they determine the cost of borrowing and the return on savings. A lower rate encourages borrowing and spending, stimulating economic activity. Conversely, higher rates slow borrowing, reduce inflationary pressure, and encourage saving. These shifts ripple through personal finances, business investment decisions, and global capital flows. 3. Managing inflation through monetary policy. Inflation erodes purchasing power, and controlling it is a central bank priority. Central banks monitor inflation indicators and adjust monetary policy to maintain stability. By changing interest rates or using tools like open market operations, they influence spending and investment behavior. Too much money in circulation can drive prices up, while too little can stifle growth. Central banks walk a delicate balance between encouraging economic activity and preventing runaway inflation. 4. Central banks as lenders of last resort. During financial crises, central banks act as lenders of last resort, providing liquidity to banks and financial institutions to prevent collapse. This function ensures stability in the banking system, preserving trust and preventing panic. For example, during economic downturns, central banks inject cash into struggling banks to maintain lending capacity, ensuring individuals and businesses continue to access credit. 5. Influencing credit, availability, and economic activity. By controlling money supply and interest rates, central banks directly affect credit availability. When banks have access to cheap money, they lend more, encouraging businesses to expand and consumers to spend. When credit tightens, growth slows and financial activity contracts. These policies have cascading effects on employment, investment, and overall economic confidence. 6. Currency valuation and global influence. Central banks influence not only domestic money, but also international currency values. Exchange rates respond to interest rate policies, foreign investment, and monetary stability. A strong currency reduces import costs, but may hurt exports, while a weaker currency encourages export growth but increases domestic costs. Central banks must carefully manage these trade-offs to maintain economic balance. Currency fluctuations directly impact investments, travel costs, and international trade. 7. Quantitative easing and money expansion. Quantitative easing is a tool used during extreme economic conditions when conventional interest rate policy is insufficient. Central banks purchase financial assets like government bonds to inject liquidity into the economy. This increases money supply, lowers borrowing costs, and encourages spending. While effective in stimulating growth, it can also risk long-term inflation if mismanaged. The consequences are visible in stock markets, bond yields, and real estate prices. 8. Regulating banks and financial institutions. Central banks oversee the banking system, setting rules for capital reserves, lending practices, and risk management. By ensuring banks remain solvent and compliant, central banks prevent systemic failures that could devastate the economy. These regulations indirectly affect borrowing costs, credit availability, and the safety of deposits. Without this oversight, economies would face higher volatility and uncertainty. 9. Communicating policy and market expectations. Central banks influence not only through actions, but also through communication. Statements, reports, and forecasts shape market expectations, guiding investment and consumption decisions. When central banks signal future rate changes or policy shifts, markets adjust in advance, demonstrating the anticipatory power of central bank communication. This creates a feedback loop. Market behavior responds to anticipated policy, which in turn influences economic conditions. Savvy observers can interpret central bank messaging to make informed financial decisions. 10. The invisible force that shapes financial life. Ultimately, central banks act as invisible architects of the economy, quietly shaping money, credit, inflation, and investment behavior. Individuals may never see these interventions, but the effects ripple through mortgages, loans, investment returns, and even prices at the grocery store. Understanding their role allows people to anticipate risks, recognize opportunities, and structure personal and business finances strategically. Central banks are not omnipotent, but their influence is profound, systematic, and ongoing. Those who understand this hidden force gain clarity, control, and foresight in an economy largely governed by invisible hands. Central banks quietly determine the flow of money, credit, and economic stability, influencing outcomes long before individuals make decisions. Their policies ripple through interest rates, inflation, currency, and markets, shaping wealth and opportunity for everyone. Understanding their role allows individuals to protect assets, anticipate risks, and capitalize on opportunities. Like and subscribe to continue learning how these unseen forces shape financial life and how you can navigate them strategically.